Hello and welcome back to another episode of the Lonear Capital podcast. Back where we're supposed to be. I'm here in Phoenix, Arizona, sunny Phoenix, Arizona, and Rob is in, I think now sunny New York City. Back from over a month traveling, a rigorous schedule, but here we are. We're right where we're supposed to be. Looking forward to having a great podcast. Once more, I'm the Director of Business Development, and I'm alongside the founder and CEO of the firm, Rob Beardsley. Before we get into the podcast today, I have to give the consistent ad, which is we've got our Lonear Capital Summit event in New York City on September 14th and 15th. This will be the fifth iteration of the event, and it is poised to be the best version of the event yet. And there's two ways you make an event better and better each year, which is making sure that the programming and the content and the agenda is dialed up. This will be the best version of that, with keynotes by Rob Beardsley as well as Paul Hutchinson. And the other way this will be the best event, and this is probably the true X factor, is the people who are coming. And to this point, we've got a incredible turnout, an incredible amount of people who have already registered for this event. We are selling tickets like hotcakes. It is crazy. We're way more than halfway to goal. And this is in a market that is shrinking, if you will. It's no secret that the commercial real estate market's going through tough times right now. But this is the time, if you're an operator or if you're a fund manager or an investor, to really decide and figure out, well, who are the next people that are coming up in the business? Who are doing deals in 2025 and beyond? Who were doing deals in 2015 to 2020 was one thing. Who were doing deals from 2020 to 2025 is another thing. And then who will be doing deals from 2025 to 2030 is a whole nother conversation. So figuring out who's there, combing through the list of people who are quality is what you're going to get out of this event. Rob and I have spent, or I guess Rob, I should say, has spent, and I've been in receipt of about over $50,000 to hundreds of thousands of dollars probably actually in going to conferences over, call it the last better part of a decade, to meet all the people that typically speaking attend our events. We comb through this list all the time. We don't need to be sending deals to people who don't want to be receiving them. So the people who are going to this event and are going to be, in attendance are going to be people that we're doing deals with, that, are our friends who we deem to be quality and reputable sponsors in the business. So all that said, you really do not want to miss this event. This will be the best version of it. Rob, did I mention anything regarding that?
You mentioned quite a few things regarding it.
Well,
I don't
that I
think you
can't
missed.
mention.
I don't think you missed anything either.
Yes, very good. Well, I've gotten that down a couple times. Is the only ad read we're doing that is for that right now. But as I said, if you want to go to this event, please fill out the application. It is an application only. There's no riffraff. We'll know everyone in the room, which makes it that much more valuable. So please, if you are wanting to learn more about the commercial real estate world, who's doing deals, fill out the application. Perhaps you'll get accepted. Moving on to the podcast today. Rob and I had this conversation, I think off air the other day, and we said, well, you know what? Why not make it a broader topic for the podcast, which is when buying real estate correctly, it is the best investment. So I think people have heard, how real estate is superior, but let's actually conceptualize and break it down as to exactly how you do get the best outcome here. So Rob, without further ado, take us away as to how you think about this.
Yeah, this topic has been on my mind for a while as I've been battling. I don't want to say battling, but I've been bouncing around the different thoughts in my head as far as the return and risk of the S&P 500. The S&P 500 is one of the greatest investments ever in history. It's just such a wonderful invention. You've got the biggest, best 500 companies in America. They're public. The S&P 500 index is a liquid index. It balances for you tax efficiently. There's so many things to like about the S&P 500. It's such a great investment. And then I was kind of breaking down, getting into the weeds of that, like the PE ratio and the growth of the earnings and multiple expansion, contraction, or what are all these things, right? And then I kind of, as I was getting into the nerdiness of all that, I thought about, okay, well, how does this relate back to real estate? And how does this relate back to the attractiveness or the competitiveness of investing in what we do compared to the other options, right? Because that's that's the truth of the world, is there's options, there's opportunity costs. If you're investing here, you're not investing there. And so I was trying to think about, okay, well, if the risk and reward of the S&P 500 is X, and we can kind of get into that and kind of figure out what we think those numbers are. Okay, well, what's the risk and reward of real estate? Is it more? Is it less? And then I kind of thought about it and said, wow, like investing in the market, people know this. It's great, and it's very hard to beat the market. But if you invest in the market, it's also very hard to underperform the market. It's still possible, and most people do, because of the foibles of human emotion, right? And unfortunately, when a stock is so liquid, it's easy to press the sell button in a panic, and it's easy to press the sell button in a euphoria, or worse, hit the buy button in a euphoria.
Yeah, it's only going up, right? Unfortunately, the logic for so many people is they see red numbers, they panic, they sell. They see green, and they buy more, right? It's an unfortunate thing, and I never discourage putting more contributions, more dollars to work. My gripe would be more selling than buying.
Yes, for sure. That's what gets you into trouble. So yeah, so it kind of got me thinking about it, and then basically I'm going to share my screen here and get into the nerdiness. So if you're listening to this and not watching this on YouTube, I encourage you to go to our YouTube channel and check it out. I built a little dumb spreadsheet to illustrate my thoughts here, so it's pretty easy to follow.
Coming from a
But
spreadsheet guru, I'm sure the people will love.
yeah, well, maybe I enjoy it at least. So basically, I kind of came to the conclusion that real estate is still, in spite of all the amazing things about the S&P 500 and then what that sort of index investment can yield, investing in real estate is still so difficult to beat. And however, the way that you take a good thing and you ruin it is by over leveraging it. You put too much debt on real estate. And so that's the thing. That's the thing about real estate, is it is a better investment than stocks up until the point you put too much debt on it. And that's kind of the problem that people are reckoning with now, because of the fact that they put too much debt on properties back when credit was cheap and easy and flowing, and it was kind of seductive to, oh, well, sure, I'll lever up 75%, 80%, even more. And the thing that in real estate, those numbers don't sound so crazy to us real estate guys because we're used to it. And if you're listening to this and you have ever bought a home, you might have put 10% down, 20% down, right? And that's an 80%, 90% loan to value. So in real estate, these super, super high points of leverage are normal to us. But in reality, this is a ton of leverage, right? Because when we talk about leverage in the private market, like PE, or in stocks and stuff like that, in kind of regular finance, we talk about it in terms of leverage multiples. And so if you're levered at 50%, that means you've got one part debt, one part equity, or you're levered 2x. Now, if you leverage up 66%, you're levered up one part equity, two parts debt. So now you're levered 3x, and so on and so forth. So when you're talking about 75% LTV, you're actually levered 4x. And when you talk about 80% LTV, you're actually levered 5x. And I mean, 90% is kind of insane, but 90%, as you can kind of do the math, is being levered 10x, right? And so
Well, and a
10x
lot of
leverage.
groups actually did that when they put in, 10% of equity, and then they threw in a pref stack, a preferred equity
Sure.
stack, or a mez stack. That was not that uncommon, just a short 3-4 years ago.
Sure, that's right. So the unfortunate thing is, real estate on paper it's attractive to lever up. On the spreadsheet, the more debt you put on it, oh, the IRR goes up. Oh, the cash on cash might go up. Oh, I'm a sponsor. That's less equity that I have to raise from investors. Raising equity is hard, right?
And
Asking
you
the
get
lender.
paid on the whole of the acquisition, not the equity typically raised, right?
Well, even better. Yeah. So if you're buying $100 million deal, and oh, okay, well, at 5x leverage or 80%, you only have to go out and raise $20 million, but you still get to collect an acquisition fee based on the full $100 million purchase price. Whereas if you're using more prudent leverage of 2x, 50% LTV, you now have to raise $50 million of equity to earn the same acquisition fee, the same asset management fee, assuming that your fees are structured a typical way, right? Even worse, to not get sidetracked, people are out there charging fees that are really just
Heinous.
heinous and not related to kind of the conventional way to go. But
We
that's
digress.
kind of my realization. And you can see through the numbers, right? Everyone's heard, oh, leverage cuts both ways, and I want to be safer and I want to use long-term lower leverage. But once I show you the numbers here, basically, let me just regain my train of thought here. So the concept of leverage is kind of understood, right? Everybody knows buy low, sell high. Everybody knows that the more debt you take, the greater the risk. But it's hard to really face it because you're not actually forced to face it when you look at an underwriting model. When you look at projected returns, there's no projected risk. There's no like, oh, the risk is 7.4 on this deal, or the risk is 6.8. So instead, the projections just say, oh, well, the projected IRR is this and the projected cash on cash is that. So you're actually not faced to directly reflect on the risk. And so the reason why is because risk is actually a very, very difficult number to quantify, arguably impossible to quantify, because of the nature of risk and its complexities. And you've got different types of risks. You have like payment default risk, you have the risk of external events, and there's so many different risks. But basically, in the world of finance, they try to just simplify it and make it really oversimplify it, but it works for the purposes of numbers, which is why they do that. And they just call risk as volatility. And so specifically, volatility, it is the standard deviation of returns per year. That's kind of your typical standard deviation model. So if we talk about, for example, let me ask you the question. Like, let's just take an example of like a high quality, well located Dallas multifamily property. How much do you think? And so standard deviation is basically the norm. So you've got a bell curve like this. And so you've got the mean, like here's the mean, which is the middle of the bell curve. So 50% outcome. And then you go 30% this way, 30% this way. So that's kind of 60% of the years you're going to have this result. And then anything that falls outside of that first standard deviation is in the second standard deviation, which is a far rare occurrence, right? You're talking about only happens every 20% of years. So it's a 1 in 5 year event. So I'm not going to hold you to it, but just kind of intuitively, what do you think is kind of your standard deviation, your typical 60% of the time? How much do you think price for that multifamily property goes up or goes down in any given year, 60% of the time?
I would imagine. I hate to say this. I'm almost struggling to comprehend the question with how you're asking it.
Well, okay, so I'll make it simple. So 60% of the time, I'm just going to say that a Dallas multifamily property probably goes up or down by about 10%.
Okay. Annually, you're saying?
Mm-hmm.
Okay. So how many times do I think that occurs?
No, I'm just saying that's 60% of the time. I'm
Okay.
gonna say. So I'm just gonna use that number and we can kind of
Okay.
get into it. But to give you a frame of reference, the established volatility for the S&P 500. So I'll just go like this: S&P 500, and then we'll go S&P 500 volatility. So the same number for the S&P 500 is acknowledged or agreed upon to be around 15%. So that means 60% of the time, the S&P 500 goes up, 15% above its projected return or 15% below.
Okay.
So, and that's kind of true, right? The S&P 500 over time goes up, but it's also a bumpy ride.
I imagine then statistically it's way better than the stock market, just more consistently. It's not as liquid. So I imagine whatever the stock market is, it's probably more consistently on average would be my guess. That's
Right.
my
So
take.
10% feels pretty right, I would say. It feels good, right? It's less than the S&P 500, 10%.
I mean, if you have the right debt structure in any deal, like let's say you throw 10-year debt on any deal, I feel really confident so long as you didn't make a heinous error on the front end. You could even overpay a skosh on the front end just to secure the premium, which should likely do better anyways, no matter what the market is. You could probably slightly overpay and still win if you threw 10-year debt with modest leverage.
Yeah, I agree. That's a really good way to mitigate risk. But you're still going to, and that's why volatility is not the perfect measure of risk. Those two things are not one to one, because just because price is going up and down, like the S&P 500 does, doesn't necessarily mean it's risky. Like if you know for a fact that you're going to hold that S&P 500 index for 10 years, you don't really care as much all the ups and downs. In practice, it's definitely more difficult. It's preferable to have less wiggles than more wiggles, but volatility does not equal risk. In the famous words of, I think, Charlie Munger and or Warren Buffett, they said, we'd much prefer a lumpy or bumpy 15% return than a smooth 12, right? They're willing to endure the bumps and the volatility to get to that higher return, but
Yeah.
easier said than done. So here's the thing. And also just for the sake of the S&P 500 has a projected return. Right now it's trading at around a 25 PE multiple, so about a 4 cap. And that's being generous because it's actually trading perhaps at even higher multiples than that. And then historically, the dividend payout from earnings
Is a
is
peanut
is about yeah, exactly.
a nickel?
Um, it's about 50. Well, let's be generous and call it 50%. So 50% of earnings are distributed out. So it's actually like a 2 cap. The S&P 500 is, and then the S&P 500 is comprised of wonderful companies that grow fast and they're managed super well, but it's also mature companies, big companies. And when you talk about a basket of 500, they're going to grow slightly faster than perhaps just the country's GDP growth rate and perhaps inflation.
Yeah, and it's
So
fluid. So there could be companies coming in and out that are higher growth
sure.
there.
Hmm.
Also, we've had recent years where the Magnificent Seven has really actually carried the lion's share of the work. If you actually had an index or a fund of just those companies, you'd be better off than owning the bundle of 500. But also because of the fact that someone's doing the hard work of giving you, it's serving you on a platter, the 500 best companies, yeah, you do get a little bit less of a, you do get more of a market beta because the risk is essentially taken off you. You're basically betting against America if you're not buying the S&P 500. Essentially, is the perspective and the outlook you kind of have to take on it.
Yeah, and so I'm going to use, people can agree or disagree with me, but I'm going to use 4% as the growth rate of the S&P 500 for earnings growth every year on average. And I think that's fine. And what happens now is you basically are buying the S&P 500 for a 4 cap, but actually you've got some CapEx reinvestment and all that in order to get that growth. So you're actually buying like a 2 cap, and then it's growing at 4%. So in the end, your S&P 500 return is actually projected to be 6% in the long run if you buy today. So now the Sharpe ratio is the return divided by the volatility. So if you take 6 divide by 15, that is not a percentage, but just a number. It's a 0.4 Sharpe ratio. So that just gives you a benchmark of kind of what a decent Sharpe is, because the S&P 500 is a pretty great investment. So a 0.4 Sharpe is pretty good. That just sets the stage. So I hope people are staying with me. I know I'm not doing this in the most straightforward way. I'm kind of jumping around, but now I want to go through the typical valuation for multifamily. And so there's a couple caveats that make it more complex than a simple cap rate. And those things are closing costs and then below the line expenses. So firstly, let's talk about closing costs. So with closing costs, when you buy a property, you have closing costs. So when you buy a 5 cap at $100 million, you're purchasing $5 million of income, right? So $5 million of income for $100 million. But if you have closing costs of, let's say, 2% closing costs and a 2% acquisition fee, just to make the numbers simple.
And closing costs are, lender fees, title and escrow fees, miscellaneous other items that come up in any real estate transaction, which is why actually when you're selling deals pretty quickly and, you hold them or you flip them, in a 3-year span, you're getting feed to death, whether you're buying a residential home, whether you're selling commercial real estate. It's just a lot of fees you're accruing there.
Yeah, and 2% is definitely a big number for a $100 million purchase. But this takes care of your when you close a property, you have to actually prepay the entire year's worth of insurance. That's a big number. And then you're also going to you're going to do some prorations with the seller for property taxes. And then you're going to have to escrow to the lender the delta between what your monthly escrows are until the property tax payment, in order for when that tax payment is due, you've got the full year's worth of property taxes so you can make the in arrears payment. So those funds obviously come back to you at sale because they're kind of escrows, but they're held up. That's dead money kind of basically. So if I just oversimplify it and use 4% total closing costs, I'm going to have to add 4 million to my denominator. So when I'm buying a 5 cap, I'm actually buying a 4.8 cap right off the bat due to closing costs. That's the nature of the beast. Now, the other side of the equation is below the line expenses. So cap rate only tells you one side of the story. Just to paint a quick picture, on a profit and loss statement, you have your revenue, which is basically rents and other income and all that jazz. Then you have your operating expenses, which is payroll, repairs and maintenance, admin costs, taxes, insurance, etc. And then now that the difference between those are your NOI. Then after your NOI, you actually have more expenses. That's not cash flow. So from NOI to cash flow, in between, we have a few things. We have, and I'm also going to exclude debt service because that's a different beast, but we have asset management fees. We have legal fees, like, you have Delaware entities registered to do business in Texas. You've got all these entity expenses and things like that. You also have accounting because you have to file taxes for the entity and you have to also produce the K1s and everything for the deal. And then the big one, the elephant in the room, is recurring CapEx. Now, recurring CapEx is basically all the costs to maintain the property in good condition that exceeds the operating expenses, repairs, and maintenance, because that goes real quick. And in reality, just to paint a picture, basically in our space, we typically see something around maybe 650 per unit of repairs and maintenance. But the reality is the true cost of all the repairs and maintenance for a property per year is somewhere around $1,500 to $2,000 per unit. So the difference between that, let's just say 1,650 minus this, has to come here in your recurring CapEx line. It's got to come from somewhere, but it just comes below NOI. And so then once you have this NOI subtracted by all these costs, then you actually have your true cash flow that you can actually, it's free cash flow, true free cash flow. So to quantify that, you take the 5 cap. Asset management fees are typically 2% of revenue. If you assume a 50% expense ratio, that's basically a 4% hit on NOI. So we take a 4% hit to the cap. Recurring CapEx, I estimate at 10% of NOI. So that takes you to a net income cap of 4.3% when you do this math. And then when you do the 4.3 cap, right, you take 4.3, you divide it by the $100 purchase price, but oh wait, it's actually $104 purchase price. It actually gets you to a 4.13 cap. So this is the true tough nature of buying a 5 cap. A 5 cap is actually a true 4.13 cap at the end of the day. Similarly, with the S&P 500, it's maybe trading at a 25x PE ratio, which means that earnings multiplied by 25 equals the market cap of all those stocks, which is a 4 cap. But in reality, it's not a 4 cap because you actually have capital investments, reinvestments in order to be able to continue to see that strong growth rate. So that's the true number there. So now, typically we expect rents to grow at about 3%. And so we can expect the growth rate of the cap to be around 3%. We could maybe get a little more aggressive because maybe you expect rents to grow a little bit faster than expenses. Maybe you think, maybe you'll get 3.5% out of that, right? Another thing that is common is a value add plan. Maybe you're buying the 5 cap, but you actually see it as a value add opportunity where there's meat on the bone and you can renovate some units or push other income or you can reduce some expenses. And so we're estimating that as just a 10% pop to NOI in the first year. So let's say, you can actually buy a 5.25 cap, so a little bit better. You can get a value add pop. And then here I just have some other ancillary assumptions like the preferred return and the interest rate on the debt for the project, and then the leverage multiple. And then we already talked about volatility, which is just kind of that number we pulled out of the sky. So hopefully everyone's not asleep yet, because now we're finally getting to the good part. So now we can actually look at the projections here. And you know what we're going to do? We're going to start with unlevered returns. So leverage multiple of 1. That means
You bought it all cash.
bought it all cash. So that means, you paid $104 or $104 million, however you want to look at this deal. And in the first year, in year 0, you're buying a true 4.34 cap. But through your magical value add, you're actually able to get some rent growth, and you're able to actually year
So-
1 looking at a 4.93.
And the true cap, are you referring to now at this point yield on cost for those who are privy?
Even yes, because I am factoring these costs.
Unlevered yield on cost, right?
Well, yield on cost is always unlevered, but yes, 100%. But I'm actually taking it a step further because I'm actually factoring in below the line expenses, mainly recurring CapEx, to get to that free cash flow number, basically.
I see.
So you can see we're boosting it up to 4.93 in year 1, and then we get the 3.5% growth, and then we revert, meaning we sell the property at the end of 5 years, and we simply just sell it at our going in. We sell the income in year 5 at our true going in cap. That's it. Keep it super simple. So we bought it for basically 104, and we're selling
No cap rate expansion nor compression, just
Yep.
same.
And that's the same exact assumptions I made in our S&P 500 analysis. I just didn't assume any sort of multiple expansion, multiple contraction. It's just a 6% long-term return, assuming that you buy it, the S&P 500, at a 25 PE ratio, and then 5 years, 10 years, 100 years later when you sell, 25 PE ratio. So when you put an IRR on that, that gets you to a 9.25 unlevered IRR. And then we talked about the volatility being 10%. So in order to get the Sharpe ratio, well, actually, real quick, we're going to take the...
Well, it's unlevered too. So if you apply, even 50% leverage, which is modest with fixed rate debt, this looks pretty good, does it not?
Well, we'll get there in a sec, because first I want to show how we're going to do some modeling here on the preferred return and the waterfall, because the 9.25 IRR gets you to an 8.9 basically net to investor. So then you take that 8.9 and you divide it by 10%, which then gets you your Sharpe ratio of 0.89. So this Sharpe ratio of an unlevered investment here worked out amazingly, over double the Sharpe ratio of the S&P 500. We're crushing S&P 500 returns.
And that's unlevered.
And that's unlevered.
Well, what if we are more generous to the stock market in the S&P 500 and give it an 8? Let's say an 8% return. Can we do that?
Yep.
Because most people say, oh, it's an 8 to 10%, whatever.
Mm-hmm.
Why don't we put it to a 9 and be really aggressive on the stock market and give it some credit?
There's it's almost impossible for the S&P 500 to return 9% in this. I'm gonna go with it, but
let's beat the numbers up.
If you buy the S&P 500 today at around a 25 or greater PE multiple, you cannot
hold it for 10 years.
Yeah, you cannot expect long-term returns of 9%, because you'd be making the assumption that either the CapEx is going to become free and that all your earnings become dividends, or or a combination. You have to get 7% growth every single year, which would be unbelievable growth. And so maybe some people with AI believe in that, but let's go with 9%. Takes you to 0.6 Sharpe.
We're still beating it at 9%.
At a 0.9 Sharpe, basically.
Yeah.
And so this is like the eye opener, because you go, oh wow, this is amazing. And then the
unlevered.
other thing, yeah, but here's where it gets not so fun. Leverage actually is not accretive to the Sharpe ratio. And this is what's sad about real estate, because real estate guys like us, we love to lever up. We say, yeah, real estate, you have to use debt and all that jazz. And it's true. But the reality is, this is as good as the Sharpe is going to look in today's playing around here.
So the Sharpe looks better now, but then the return will look better, though the levered return will obviously be enhanced.
Right, exactly. In order to get better projected returns, you're going to have to see an increase in risk, and it's not going to be a 1-for-1 increase. It's going to be an unaccretive increase in risk. Risk is going to grow non-linearly with your projected returns, which is going to then hinder Sharpe. So that's the unfortunate reality of pursuing higher returns. So at the end of the day, Sharpe doesn't pay your bills, and nor does IRR, right? It's all about actual dollars in your bank. But these are just good ways to evaluate things and see what things look like on the spreadsheet to get a realistic look at things. So let's go to 50% leverage and take the leverage multiple to 2. When you do that, the Sharpe drops to 0.58. The net levered IRR to investor goes to 11.7. So very good IRR. 11.7 is really good. Don't let anybody tell you otherwise. But the problem is when you use 2x leverage, your volatility goes from 10 to 20. So now all of a sudden your volatility is higher than the stock market. So you just took an investment that is less risky than the stock market, but because you levered it 2x, it's now actually riskier.
What if we do call it 60% LTV or LTC? There you go. There you get to your magic 15%.
Yeah, I mean a 13 IRR is basically, plus 4%, just for rough numbers. Basically gets you to a 17% annualized return, and 17% annualized return
At
is really
17
amazing.
AR.
Yeah, exactly. And if you do that over 5 years times 5, you're getting a 1.85 equity multiple. So you're almost doubling your money in 5 years on a 13 IRR, and you're doing it at a 0.52 Sharpe. So you're taking your Sharpe is you're taking a little more risk in the stock market.
And this is the 10-year hold example?
This is
or just anything?
This is any hold. This works for this just based on the way the numbers are set up, because there's no multiple expansion, contraction, cap rate contraction, or anything like that nature.
This is more back of the napkin, if you will. Back of the Excel napkin.
Yes, back of the Excel napkin. So a
That might
0.52 Sharpe,
be a new phrase.
0.52 Sharpe is definitely not bad. But you can see that as we ramp up the leverage, the Sharpe gets worse and worse, but the returns continue to go up. And like I said, that's just simply because the way that you calculate the Sharpe is by just taking the volatility and multiplying it by the leverage multiple, because with every turn of leverage, you're essentially increasing volatility, therefore risk, by that same amount. So now let's go to something that people are very familiar with. Let's go to 75% leverage. So now
in today's economy, are you kidding me?
So now the projected IRR for investors is 17.3, right? That's probably what a lot of people see hitting their inbox by people are pitching them deals. Oh, invest in this, invest in that. It's got a 21% annual, AAR. It's got a 17% IRR. The problem is you're starting to take quite a lot of risk. To put the vol in perspective, just to make it plain and simple, you're just taking the leverage multiple and multiplying it by the volatility, and that is the volatility of that investment, 40%. That means in any given year, you can, 60% of the time, your investment's going to go up or down by 40%. And guess what? When you are levered 4x, you're only putting in 25% of the deal as equity. So, there's a chance 60% of the time that you're wiped out.
I think people fail to realize this going into it, particularly when the market's super hot. But now, as people are resetting, and you've got those who are committed to the investment model of multifamily real estate and other alternatives, frankly, looking at this and understanding how to analyze a good or bad investment, particularly when you're throwing on debt, which likely everyone is, this is a very good reminder as to how you underwrite correctly and how you assess this. And, I think Rob and I have really been good about telling everyone, hey, the stock market is a good option. There are other good options in the marketplace to invest other than the stock market, other than multifamily. Like anything, I'm a big fan of making annual contributions, not perpetually moving money in and out, whether it be doing deals in multifamily or buying residential properties that you're going to hold for probably 5+ years. Somewhere between 5 to 10. I think 7 is a sweet spot. and making annual stock market contributions. Perhaps when the PE ratios, as you alluded to, is a skosh more favorable due to what you're kind of forecasting with where that right now.
Yeah, that's right. So, I mean, really, I think the point that should be driven home, there's actually two big points. One that we've already kind of been touching on, and one we haven't. The one that we've been touching on is that leverage is more risky than you really give it credit for, and it's actually not as accretive as you give it credit for. Because yeah, sure, this projected return has gone up as we've used more leverage, but the Sharpe is going down consequently every single time we add more turns of leverage. So, and it's also in the eye of the beholder. Maybe someone looks at this and says, you know what, this is exactly what I'm looking for. I'm looking for an investment that has a 0.43 Sharpe where the volatility is 40% and I can target over 20% per year average returns, right? But if you want to sleep well at night in investing in real estate, you want to buy high quality assets, you want to use high quality debt long term, you want to stick in that sweet spot of around 2 to 2.5x leverage, which correlates basically to 50 to 60% LTV. So that is that's just kind of the way the numbers bear out. When you use 2.5% here, you're at a Sharpe of about 0.5, which if we're going to kind of go in all honesty and kind of go like this, like you want to beat the S&P 500. That's the goal. That brings warmth to my heart. If we're not beating the S&P 500, that's no good.
Yeah. So, in summation, what does this mean for investors? How do they win from this? How can they apply this to their life if they're an investor? If you're an investor listening to this, if you're a capital raiser, how can you take some wins from this, just high level? And then what does this mean for Lone Star Capital as we move forward with our decision making to help our investors and ourselves sleep well at night?
Yeah, as an investor, it's never a bad idea to spend a little more time thinking about risk and to think about whether the added risk of the deal through leverage is actually worth it. Because we get it, no one's even really buying real estate unlevered. That's very rare. But and for most people this is not attractive. Some people, they're not in the game for a 9% return, right, or 8% or whatever it is when it's unlevered. Also, when you use
And
leverage,
frankly, if it's illiquid, why would I want to do that for an illiquid investment just for 9% if I give you in the stock market, right?
yeah, I mean that's a good point too. And also, people invest in real estate. This was the second big point. People invest in real estate for tax benefits, and that's really what edges real estate ahead of the S&P 500, in my opinion. Like we said, we think there's an absolute place. We're not trying to replace. We're just trying to add. We're trying to add diversification. S&P 500 has a place in your portfolio, and so does private real estate because of the difference in return profile, the monthly cash flow, and very much so the tax benefits. And so when you use more leverage, you actually get more tax benefits per invested dollar. So that's something to consider as well, which is why it's actually better to not invest unlevered. So using 2 to 2.5x leverage, which is 50 to 60% LTV, we think makes a lot of sense. That's really what we're sticking to for the most part at Lone Star. And we think that's the best option for us and for our investors. And that's difficult because when you use less leverage, the returns are going to look less attractive on paper. So on the spreadsheet, in the pitch deck, on the investment pitch webinar or the phone call, the returns aren't going to look as amazing. But something that nobody's talking about, which is the Sharpe ratio, and I don't think they should be. I don't think we should bring that nerdy quantitative finance stuff over to the real estate world. We're real estate guys
Unless you want
after
people
all.
to snooze, yeah.
Yeah. We're the jockey real estate guys, so we don't need to bring this to our industry. But nobody's talking about this, and people are missing the point about risk-adjusted returns. We talk about risk-adjusted returns, but it's just a canard that doesn't actually carry meaning until you actually stare at the numbers in the spreadsheet like this.
Makes sense. And I'm assuming this return structure factors in cash flow along the way as perhaps a part of it, or is this just pure appreciation you're showing here?
Yeah, this is the IRR, so it factors in everything, the cash flow and the appreciation that you get.
Very good. It's excellent. Any other thoughts as we wrap up the conversation today and we move on?
No, I'd love to hear people's feedback. Like, was this rant helpful, interesting, confusing? What did we miss? What did we get wrong? Maybe people think, like there's some people that think, oh, the stock market's going to only return 2% over the next 2 years or 10 years. Or some people are sticking kind of to their, no, the stock market does 10% every year. I can count on it. Money in the bank.
Yeah. I mean, investing is not easy. But I think like multifamily or stock market, S&P 500, the real gains are left by keeping it in and by not moving around, but just sitting back and, treating the S&P 500 like a passive investment where you set it and forget it. That's how I'm looking at these things. I want my money to compound like that. I know that over the course of time, if I just hit singles and doubles consistently, I'll be exactly where I want to be. And hopefully our investors who are smart and wise look at the world the same way. With that said, we appreciate your time today. We'll see you next week on the Lone Star Capital podcast. If you have any questions, emails, or things you need Rob and I to be thinking about or addressing on the show, we'd love to hear from you. Email me at Craig, CRAIG, @lscre.com. And if you're looking to learn more about the summit event, go to our website, www.lscre.com. Go to the About
LSC
section.
Summit. No. Just cut the line and go straight to lscsummit.com.
Yeah, well, if you go to the About page on our website, you will also see the Summit tab there as well. But shortcut it if you want to go Rob's route as well. Either or gets you to the point. We look forward to seeing you and put your application there. Say you heard about it from the podcast. Thank you for your time today.